So I just want to thank you all for coming. My name is Amy Belmore from Heidrea for Heroes. So we're presenting this program as part of our Success Readiness seminar series, which we've launched back in September. We hold programs like these once a month, and we'll be continuing to do so through May. So you can stay tuned to our website, and you'll be getting wrap-up emails from us and that kind of thing. But for Chris, I know that you're familiar a little bit with Heidrea for Heroes. But for those who aren't, we do have other services that we offer. So we serve veterans from throughout Southeastern Mass. And kind of two lines of work that we focus on. One is individual project fulfillment for veterans with a hardship or veterans in need of some type of support. That can take the form of wheelchair ramps or qualifying home repairs or mobility equipment or a computer for schooling or some situation where that veteran is in need and we may be able to provide the custom solution to that need. In addition to that, this Success Readiness seminar series is really about providing workforce readiness as well as personal skills for success for veterans who may be coming more recently back from military life and entering civilian life, or maybe not so recently. And so we were delighted back in September to partner with Massasoit Community College on this series as a whole, and the series is also funded by a grant that was provided by Bristol County Savings Bank. And so the presenter tonight, who we'll introduce in just a minute, is coming to us from Bristol County Savings Bank, and is going to be talking about first-time home buying. And so we really want to encourage you to ask as many questions as you have. Bearing in mind, as we talked about a little bit earlier, there is a webinar that's going to be coming out of this as well. So if you have other people in your network or friends or veterans that you talk to, there's a lot of information that will be, valuable information for non-veterans as well, just about first-time home buying. But some of this information is specific to loans that are available to veterans, and that's why we're presenting it to you tonight. So when you do receive that wrap-up email from us with the webinar link, please feel free to share it widely. So we just hope you enjoy the night. Now I want to introduce Jennifer Oldfield from Bristol County Savings Bank. She's a mortgage consultant there, and she's going to walk you through all of these details. Thank you so much.
Hello, thank you for coming tonight. My name's Jen Biggs Oldfield, and I've been the mortgage consultant in the Taunton area, the greater Taunton area for Bristol County Savings Bank for 19 years now. The bank's a fantastic bank. It's a great place to work. Obviously, I've been there for a long period of time. And the bank's pleased to be a sponsor for Heidrea for Heroes. We're excited about it. We want to help the veterans. We want to give back to you for everything that you've done for us. So I'm definitely a resource. I'm here tonight. But especially with mortgages, it's a very personal experience. So one-on-one, if you want to sit down, whether you're going to buy in a couple months, in a year or so, but you just want to lay the groundwork to make sure you have all your ducks in a row, I'll meet with you as often as you need to make sure that we have the right plan in place for you so that you succeed. The bank's been around for 160 years. So again, I like to bring that up because nowadays with banks changing and things moving around, it's nice to have a good solid bank, and we've been in the community and involved in the community and tried to, again, promote home ownership and help people succeed in home ownership for many years in the community. I'm going to be talking about mortgages for a while, and my boyfriend likes to say that it's not so exciting. Usually when he has trouble falling asleep, he'll call me up and say, "Honey, tell me about your day. What were the mortgage rates? I can't fall asleep tonight." So I'm going to ask you to maybe participate a little bit, and like they were saying before, we'll make sure that we talk nice and loud so anybody else can hear what's going on too. But I do like it to be a little interactive because you're going to get tired of hearing my voice after a while, and I'm sure anybody else out there is going to have a lot of the same questions that you have. So I'd like there to be some back and forth. Don't hesitate to stop me if you want me to explain about something a little bit more, or if you have a specific question. I forgot I have visuals. So why are you here tonight? Your goal is to buy a house. Paul, what do you think your time frame is as far as buying a house?
Probably within a year, under a year.
So maybe about a year or so. And Chris, how about you?
I would say a similar time frame.
Similar time frame. Okay, so I think now is the perfect time for you to start getting your information. I don't think you can have enough education when it comes to things like this, when it comes to your finances, to make sure that you are making good decisions for yourself. So you've already gone through one of the questions, should I rent or should I own? So what did you see before? What did you see as some of the benefits of renting? Why do you think you were renting before versus owning a house previously?
I rent right now, and it's easier as far as the maintenance. My owners take care of the maintenance. They take care of some of the other utility costs.
So maintenance?
Landscaping, some of those are taken care of.
Utilities, landscaping, yep. All those things are off your shoulder. The lawn's getting high, and you call the landlord, say, they haven't come over here to mow the lawn lately. Anything else, Chris, that you can think of?
And there's significant investments with purchasing a house. Purchasing a house, things like a refrigerator, oven, those types of things, lawnmower, snowblower, all those extra costs.
So more expenses other than just your rent, those things, if the refrigerator, if any of those utilities, appliances rather, go, again, it's off your shoulders. It's something that you can call the man. One of the other things that we usually talk about with renting is it's not as long a commitment. You might want to try out an area but not stay there or you're not sure if you want to stay there for a long time. So, you might be on a tenant at will or a one-year lease. You're not tied to necessarily that one area for a long period of time if you're not sure if that's where you want to be yet. Or you just don't have the stability either. You might not have a steady job. You might be looking around and not want to buy a house yet. Well, you'd need a job too to do that. But you might want to make sure that all that stuff's in place and not tie yourself to an area not knowing what your commute's going to be once you have a steady job. Kind of in light of what you were saying, Chris, with the appliances, you're also not going to be obligated to pay taxes or homeowners insurance. As a renter, you probably should have content insurance. If you have collectibles, if there were a fire, you want your stuff to be covered. Your landlord's responsible for the structure itself, but that obviously is a lower expense than what it would be if you were paying the insurance and the taxes for the whole property. So again, some of the benefits of renting. Now, I think you started alluding to the benefits of actually owning a home. What do you see some of the benefits of owning a home? Equity, yep. You got the first answer every time. Oh, you're cheating. I'm sorry. Go ahead. How about you, Chris? Without cheating.
Well, you're talking about a piece of land that you do what you want with. You don't have to worry about, a neighbor if it's a single family, no disturbance. Much more peaceful.
You can paint the walls. You can hang up your pictures, move things around, decide to knock down a wall and open it up. Yeah, things that you can't do when you're renting. So you can do those things. Also, when you have your home and you're paying your mortgage, one of the few things that we have to write off on our taxes is our mortgage interest that we pay. I just found out today that private mortgage insurance, I don't want to get too far ahead, but private mortgage insurance, which you pay when you put typically less than 20% down in a house, they're actually extending that benefit for another year where you can write that off on your taxes as well. So private mortgage insurance, and then points. Some mortgages come along with points. There are additional fees that are added to your closing costs in certain circumstances. Those points can be deducted too and bring down your tax liability. So steps in buying a home. You're taking the first step today. And again, I think education should be the first step. This is where you are today. You've been looking, you've rented, and now you're determining, are you ready to buy now? Or what do I need to do so that I am ready to buy and be successful? What I did was on the left side of the folder, and I found it online, is a housing budget. If you look in the folder that I gave you, the green Bristol County Savings Bank one. On the left-hand side, there's an example of some things that you can kind of put together a budget, what you think your life's going to be when you're living in a home. When the bank's looking over your application to see how much you can afford, they're going to be looking at your gross pay. Your gross pay before taxes and before any deductions for homeowners, health insurance or retirement funds, things like that. You obviously are going to be coming in with a lot less money than that. You have your take-home pay, and that's what you're going to base your numbers off of, is what you're bringing in every month. It's usually easier to do it on a monthly basis. So in the first box, you would take your salary, Social Security. As long as we can show Social Security, veterans benefits, anything like that, as long as we can show it's going to continue for 3 years, we can add that to your income. Now, Social Security income and your VA benefits are not taxed. So if we're looking at your figures gross and we want to compare apples to apples, we actually gross up those income figures so that you're on an even playing field with somebody who receives like a W-2. So sometimes, again, you're looking at your net pay, but when you go into the bank, they're actually going to bump up that income a little bit to help you qualify for a little bit more. So if you do receive Social Security, a type of income that's not taxed, and we can show that it's going to continue for 3 years, you will be able to use that. So again, pension, if you were receiving a pension, interest income, if you had assets in the bank that were earning interest, if we can show that for 2 years, we could actually add that to your income as well if you weren't using it for the down payment, because obviously if you've been getting interest on that money and you're not going to have that income going forward if it's going as the down payment on the house. If you received alimony or child support, and again we could show that that was going to continue for more than 3 years in proof of receipt, we could use that income. If you owned real estate, we could use rental income. Dividends, pretty much the same as interest. If you had unemployment, typically unemployment is not an allowed income source because it's temporary. Usually you're not on unemployment for 3 years. However, in some fields, construction, landscaping, if they're seasonal, you could be with the same company for 5, 6, 7 years, and maybe every winter you get laid off and you collect unemployment. Well, if we can show that you get that every year, looking at your last 2 years, say tax returns, and you're going to be rehired, they'll actually let you use that unemployment income and add it to your regular income that you make over there so that you're not, again, at a disadvantage. And then I don't think I've ever in my 25 years of mortgages run into anybody who receives royalties enough. But if you were, somebody who did a screenplay or wrote a book and you had royalties, again, we're looking at that 2-year history to determine your income. This year the last couple of years, there have been a lot of changes. You have a question?
Yeah, in regards to the retirement, so if you're paying into a retirement plan, how do they factor it off the interest, or how much is actually in there? How's that determined? Are you talking about if you're paying into retirement, the interest that you receive from your retirement? The interest it's earning, the money that you're putting in there, or?
Yeah, that's staying right in there, so that's not income that you're receiving and you're spending. It's pretty much accruing, so that wouldn't be interest that you would accrue as income to qualify you for a mortgage.
That doesn't hold any bearing with that
Nope, that's it's pretty much self-contained. It would be looked at as an asset. So if you had a 401k or a retirement plan, say if you had $100,000 in there, we take 60% of that and add it to the application. So we would add $60,000 as an asset, because if you had to withdraw it, you would pay taxes and penalties. So that's the figure that they use. Generally, some people will use retirement funds for a home purchase. You're allowed to do that. If you pay you might not get a penalty, but you'll pay taxes on the money that you take out. So again, it can be used as an asset, not so much for income. But we're pretty much not going to be using it for income. It's just going to be sitting there as an asset. And even if you're not using it as the down payment, we'll use it as a reserve. So after you put your down payment on the house, the bank likes to see that you have something to fall back on in case of an emergency if something were to happen, to help with your mortgage payments. So although we wouldn't want you to, we can see that the retirement's there. So if you were going to go into foreclosure, you would have something to tap into because that's an allowable withdrawal as well, typically.
And Jennifer, you said that the banks look at the gross pay for determining the loan amount?
In determining how much you can afford. So generally, depending on your down payment, yep. For instance, if you were putting 3% down, as a general rule, about 41% of your gross monthly income can go towards your house plus your other monthly bills. The more you put down, if you were to put 5%, they'll allow you to go 45% of your gross monthly income. I don't necessarily recommend it. 45%, almost half of your gross monthly income, does not leave you very much to live off of. That's why doing a housing budget is important. Now, not everybody likes numbers. I actually hate math. I do it every day, but I say it's not really numbers. To me, it's money, and I like money. Whether it's my money or somebody else's money, I love helping people put together a budget for a plan that they're going to be able to live with. Right, so you want to figure 45%, half of that isn't going to leave you a lot of money left over. So that's where the budget's important. So that's where I was going. So not everybody likes to do these numbers out and figure what their utilities are going to be. So the other thing you can do is say, okay, well, I'm paying rent, I'm paying $800 a month, and I'm putting away some money in the bank right now. Let's assume my mortgage payment for what I want. You could come to the bank and we could work this out again as a general rule before you start looking at houses and say, yeah, I think I'm comfortable with, say, $1,400 a month. Well, before you get into that house, before you go looking at them, start putting $1,400 away. If you're paying $800 in rent, start putting $600 away. And I always say, I don't care if you put it in a shoebox under the bed, give it to your mom to hold on to, open up a separate account. But once it's there, it's there. You can't even take $30 to go out for pizza on a Friday night. So you know what your life's going to be like making that payment every month. And a lot of people seem to like that better. And a lot of people say, I might not have put that extra money away if you hadn't said that, and now I have money for some furniture or my appliances or whatever. So it's nice to test drive that payment before you get there. And I find that to have been more successful than when I used to send people home with a budget and they kind of walked out the door probably grumbling about me making them do homework. But I think it's important. And knowing, and whether you do it this way or whether you put that money aside or both, I think that's going to help you make the best decisions. And once you find that comfort level with that payment, then we can kind of back out what are taxes going to be, what's your homeowner's insurance going to be, what does that mortgage payment equate, is it $250,000? And then we work with what your down payment. And that's probably going to be the best way for you to start to get ready. That would be, if you walk away from anything today, I would say that's your next best thing to do. So determine if you're ready to buy. Determine how much you can afford. So again, sometimes when the bank goes through these numbers, we may say, you can get a house for $300,000. You say, that sounds great. And then we look at the monthly payment and you say, I don't want to pay that a month. Even if you'll give it to me, I don't want to worry about going out for pizza on a Friday night. Although we've already determined nobody here wants to eat pizza. Sushi. So then what I usually say is we'll go back to what's your comfort level. And if it's not close to where the bank you might not want to have a pre-approval letter out there that says you can afford $300,000. Sometimes it can work in your favor. You don't know what the seller's circumstance is on the other side of the desk. Maybe they've had a couple buyers fall through and they're frustrated and they're like, oh, is anybody going to be able to buy this house? Or they may say, well, they can afford way more than this house. Why shouldn't I accept a full price offer? You don't know what their mentality is going to be. Or they're going to say, geez, at least this person, they should be able to get the mortgage because they can afford more. You're not sure. But I don't usually recommend kind of tipping your hand. I usually say, if you feel comfortable at a payment of about $250, that's what we'll have on the pre-approval letter. If something comes along and you find a house that's a great deal for $270 and you say, wow, I didn't think I'd get anything this nice for this price, and we know we'll rerun the numbers and get you a new pre-approval letter so you could submit an offer. But it's kind of that whole thing, if you go to buy a car and you say, okay, I want to spend $300, and you walk out afterwards going, how am I paying $400 a month for a car? I didn't want to I don't want you to have that same experience buying a house, because it's a much bigger deal, a much bigger payment, and it's much harder to walk away from it.
Jennifer, quick question on pre-approval letters. Any disadvantage to having those?
No, I'm going to get to that just a little bit later. It's actually coming up very shortly. No, you almost can't buy a house without a pre-approval letter today. Real estate agents want to make sure that if they're going to invest their time in you, that you're qualified. Same thing with all the offers out there. Your sellers want to see, okay, if I'm going to take this house off the market, is this person viable? Have they already gone through the process? And there's some new regulations that have come out that have made that even more important, I think, getting a pre-approval. But when I first started in the business so long ago that I don't want to think about it, most of my referrals came from the real estate agents. They would be showing somebody a house, and then they'd say, go talk to the bank. Now, the world's changed a lot over the last few years, and more people come to the bank first and then go to the real estate agent, which I think is a much more logical flow of business. So we're going to determine how much you can afford, and then the next thing is going to be, what's the best mortgage option for you? And I'm going to tie this more in towards the end. You guys have your DD-214s, and I call them my veterans, I'm sorry. My customers who are veterans come in and say, I want a VA loan. And again, I'm going to move, and a VA loan isn't always necessarily the best choice. For borrowers who have good stable income and employment and really good credit scores, the VA might not be the best option. So I always say, go talk to a lender who specifically does VA loans and specializes in VA loans. And we'll put together our numbers, and you're going to shop. And then we'll put the two on the table and see which one's the better option for you. Once you have, again, your mortgage payment, there's going to be different things that we want to look at. Some programs may get you a little bit more house, and again, I'm going to kind of talk about that a little bit later, a little bit more house for that payment. But might not be as stable. The payment may adjust after a certain period of time. So those are things that we'll kind of talk about too when you sit down for your initial meeting. And again, this could be even before you're ready to be pre-approved, to say, what kind of programs am I going to look at? Do I plan on being in this house for 30 years? And people go, I'm going to die in this house. And some people say, oh, this is my starter home. I'm starting off here, but there's no way I'm staying here. And then we can look at some of the other options. Some will make a big difference in the monthly payment. Some you might just save a little, but be maybe a little bit more conservative if you end up staying in the house. So for the steps, we've got determine if you're ready, how much you can afford, which mortgage option is best for you. You're going to qualify for a loan, which is a pre-approval, and then go find your home. So now we're going to lead to what you were talking about, Paul, about the pre-approval. We'd get pre-approved. Once you get your pre-approval letter, then you'd go out and you'd be working with your real estate agent. Same thing, you're going to talk to a couple lenders. I encourage people to talk to a couple lenders. Not too many, because then you're going to be pulled in too many directions. But you're going to talk to the people that you know who have homes, who have mortgages. And I think word of mouth is usually your best option. Find out who they got their mortgages through, why they chose that lender and what they liked about them. And then you call a couple lenders and find out who's the right fit for you. And everybody has a different sales style. Somebody may love their lender, and you talk to them and go, ooh, no, that's just not the person I want to work with. So whether it's a lender or a real estate agent, you want to shop around and find someone who fits your style. Once you'll be out looking at homes, and it's so funny, sometimes I do a pre-approval, and within a week somebody's in the office, I got my home. I'm like, wow, that was quick. And I think the longest one I ever worked with was 5 years. They didn't want to spend a lot, but they were very picky, and they knew exactly what they wanted in that house. And they used to call me up, and they'd be like, I have this house, Jen, and I'd look at it and I'd go, ooh. Okay, and all these houses fell through over a 5-year period. And then it was right before my third child was born. I was about to go out on maternity leave, and they said, we found the house. And I could not believe the house. I had thought in my head, I said, they're never going to find this house that they want for this money. Lo and behold, they found the cutest house, neat as a pin for the price they wanted. And I said, here's my home number. I said, I'm not missing this. I'm going to be out on maternity leave. Call me. I'm coming to the closing. There's no way I'm not going to be here. I still get a Christmas card from them. They were good people. So as long as it takes, things change, but, I'll work with you for as long as it takes for you to get there. At that point, you'll submit an offer. Usually you'll make your offer subject to your attorney's review. And the good thing is, for instance, our attorneys, they do a lot of work. They want to do the bank's work. They want your business. So the typical to review a purchase and sales, which is what happens after your offer, the average cost is about $250. And just about all the attorneys that we use will review that at no cost for you because they're going to do the closing. That way they know that everything's in there to protect your deposit. So you could make an offer subject to review of the purchase and sales by your attorney. That way you're kind of covered. So when you go with them, then you can say, well, these are the things I want in there, and the attorneys will go back and forth. After your offer is accepted, you usually have about 10 days to have the home inspected. Now, if you go with a VA loan, chances are the home inspection is going to be required. On a conventional mortgage, a home inspection is generally not mandatory unless the property is vacant, bank-owned, or when the appraiser goes out there, the appraisal is different than the home inspection. The appraiser goes out there for the bank and does a market analysis and says, this is the value of the home. I'm comparing it to 3 to 5 other homes that are out there that are similar, and this is what they sold for. Add and subtract for the differences. So if the appraiser goes out there and says, oh, there's 4 stairs here, but there's no railing, that's a safety violation. They're going to note that, and that's something that they're going to want to see fixed. Or they say, I see some termite activity, and they're going to ask, and then we might ask for a pest inspection. Or the wiring doesn't look right, the floor is sloping, then they're going to ask for a home inspection, and maybe something from a contractor to say, this is what the cost to cure is going to be, or yeah, no, it doesn't look that, but it's an old house, it's settled, but it's secure. So those are generally when a home inspection would be required. Now, when the home inspection's done, you usually have a couple days or a certain time frame to go back to the seller and say, hey, these things came up. I didn't realize these were issues. Are you going to fix them? Do you want to lower the price and I'll fix them if it's not something that the bank's going to require? We're going to lower the price. What are we going to do in light of this? And you have, if you're not happy with the negotiations and they're not going to do what you want, then you have the opportunity to walk away, and the small binder, the earnest money that you put down with your offer would be refunded to you. But usually if they're minor things, you guys work it out between yourselves, and then you would go over into signing the purchase and sales agreement. It's a legal binding contract. So is your offer, for that matter. It's not something to take lightly, and the majority of people do. So within the purchase and sales agreement, you're agreeing upon the price, the deposit that you're putting down, which if you don't follow the terms of the contract, you could lose, and it could go to the seller for them removing the house, the time that they've lost taking the house off the market. There's dates in there that say your application has to be in by this certain date, your bank approval has to be by this date, and you have to close by this date. And they're legal binding dates. So you want to make sure that you're aware of it. There's so many times I get a purchase and sales and I look and I say, this was supposed to be in 3 days ago. If you have questions, then you call your lender ahead of time and say, hey, I'm putting these dates in here. This is what my realtors put it in. Do these sound doable to you? There's new regulations that came in after October 3rd. If at all possible, you want to try to get 60 days from your purchase and sales to your closing date, because there's new disclosure laws that we have to get paperwork to you, and then there's a waiting period, especially prior to the closing. And if for whatever reason, if that form goes to you, it's called the closing document, We generally have to get that. If we hand deliver it, we have to get it to you 4 days prior to the closing so that you have 3 days to review it. If we don't hand deliver it, it's done by email or mail. It has to be done so that they assume 3 days for you to receive it, then 3 days to review it. So you're talking almost a week and a half prior to your closing just to get that document prepared and to you. So you need to make sure if that document goes to you and then there's an error, we can't just change it. It has to be redisclosed and you have to wait those days again. So in theory, the government did something very, very good because people were showing up at closing tables going, this isn't what they told me it was going to be. And if they didn't close, they were going to lose their deposit. The seller's sitting across the table and they felt bound to it, and people got into things that they shouldn't have because they felt they had no recourse. So now there's no surprises at the closing table. You're getting it, a few days before so that you can review it, make any changes, walk away if you needed to. But basically what we disclosed to you at the time of application as far as fees and what we disclose at the time of closing really can't vary unless there's a change in circumstance. You change your mortgage program, something, it has to be significant.
And so you said that time frame is 60 days, and that's set?
Yeah, I mean,
Is that typical?
if everything falls, you should be able to do a 45-day closing. But to cover yourself and to cover your deposit, do on or before whatever the 60 days is. Because if we can close you in 45 days, great.
Yeah.
But, there's most of the attorneys, and this is something that you'll talk about with for whatever reason, if you didn't have an attorney look at it, you just want a clause in there that says, if for whatever reason, because of the new regulation, the bank has to redisclose because of TRID guidelines, it's called TRID, T-R-I-D, there's like an automatic 8-day extension. So some have put that in there as a fallout. If you were going to do 45 days, you definitely want to have that in there. TRID is the new guidelines that just came out. So what happened was, if you want me to go into the long form of it, there were, initially at the time of application, you had a good faith estimate and you had a truth in lending statement. The good faith estimate showed all the closing fees, and the truth in lending showed your payment, mortgage insurance, taxes, things like that. And then it took your interest rate and showed you over the life of the mortgage what your interest was that you were going to pay if you made one payment every month for 30 years, for instance. They took those two forms and consolidated them. And they came up instead of, now it's called the loan estimate, instead of having the two different documents. And then at the closing, you had what was called a HUD-1 settlement statement, which showed where every penny of the transaction went. And then you had your truth in lending again, which had the rate and the annual percentage rate and the interest over the life. They've combined those two forms to what they call the closing document, which makes more sense a little bit. Nobody ever knew what a HUD was. Even people would close, you say, oh, I need a copy of the HUD from the sale of your house. And they'd be like, what's a HUD? But it's, if I say to somebody now, I need the closing document from your closing, they're going to know exactly what it is because it just makes more sense. So just be careful with the dates. Again, this is something that, when you pick your lender to work with, I'm there every step of the way. I don't go away. And that's something I think that you want to look for when you're choosing a lender is how accessible are they. You can call me, email me, text message me. I work on the weekends, I work at night. It's just the nature of the business. You're usually out looking at homes after work or on the weekends. So I try to make myself as accessible as possible. So, again, I always say to everybody, there's a lot of information that we're going over. You're lucky if you remember a quarter of it. That's what your lender is there for, to walk you through the whole process. So, again, this is one educational experience. Chances are with a lot of the mortgages with first-time home buyers, you may be required to take face-to-face counseling or another home buyer education course. You could do it online or face-to-face. I usually recommend face-to-face if you can, if your schedule allows. And they're going to go through all this again. So like a lot of the nonprofits I work with, Pro Home and Taunton, they have their classes. So I volunteer my time there, and I talk about mortgages. There's a real estate agent that talks, a home inspector, homeowners insurance, a credit counselor, and everybody kind of talks about their role. So you get more information that way. And again, I already know you're going to make good educated decisions. You're going to, find people that are, good, true professional people that are going to walk you through the whole process. So you're not going to be alone. So you have your purchase and sales. Now, if you've already done a pre-approval, you're pretty much one step ahead of the game. When we've done the pre-approval, we've looked at your income, your assets, we've pulled your credit, we've looked at this whole thing, and we've already approved you. So now at this stage of the game, when you submit your full application, or your application goes live, as we call it, we're just adding the property. We're going to ask you to give us updated pay stubs. We want to make sure you're still working and your income's at the same level. Updated bank statements, depending on how long ago it was that you were pre-approved. But for the most part, we're just re-verifying the information that we had done before. And when you submit the application, that's when you're going to look at probably start paying some fees. So when you give the purchase and sales to the bank, again, now we're looking at the property in addition to you. So you're going to typically be required to pay an appraisal fee. For a single family home, it usually runs about $400. Multifamily is about $600. So this is a fee that's part of your closing costs that you're prepaying. And again, these new regulations that came in as part of TRID, we can't collect any fees from you until we've delivered that loan estimate to you. You've had a chance to review it, and you give us your intent to proceed. There's usually a lot of times a separate form that says, I intend to proceed. I've reviewed the loan estimate given to me on this date, and I want to move forward. Once we've hit that point, now we can collect a check from you. If you dated it 2 days before, we can't take it. We have to have the check dated after the date that you gave your intent to proceed, any fees for that matter. I think you're allowed to collect, we don't, but I think they're allowed to collect a credit report fee. But we can't collect appraisal fees, rate lock fees, things like that until we have your intent to proceed. So again, we're going to review all the information. We're going to request the appraisal. I touched on that before. The appraiser is going to do a market value of the property and make sure that it's a saleable property. There doesn't seem to be any issues with the property itself. And then you'll get your commitment letter. Again, on the purchase and sales, we talked about your commitment date. So you'll get this letter, and you'd provide a copy to your realtor so that they can show to the seller, look, we've met our dates in the purchase and sales for getting our mortgage approval. So now the seller knows, okay, everything's looking good, we're moving forward. You want to make sure, one of the things too when you're doing your purchase and sales, we talked about the appraised value. What happens if the appraisal comes in lower than what you're buying it for? If you don't have a clause in your purchase and sales that says subject to the appraisal coming in at the value we've agreed upon, the seller doesn't necessarily have to come down in value, in the price of the house rather. So depending on what your down payment is, you might get a denial at that point. The bank might give you a denial letter saying the collateral doesn't meet the terms that we need in order for us to give you a mortgage. We can't, it shows, you'd be financing 110% of the house, and we're not going to do that because then we're at risk. So you'd get a denial letter, and then you'd be able to get your deposit money back. But if you found this house that you love, now you say, okay, well, now what I do? If you could come up with the additional money, the bank would say, well, if we did, say 97% of what the appraised value came in, we can still move forward. If you put that clause in about the appraised value, you might be able to approach the seller again and say, look, the bank, who's a third party, unbiased, they're saying the house is worth this. If you go try to sell it to somebody else, chances are it's going to come back at the same thing. Can we renegotiate the price? I've seen sellers come down to the appraised value. I've seen them meet halfway and say, oh, well, we'll drop $5,000 and you pay $5,000 more than what it's valued at. So you can just kind of negotiate again at that point, or decide, maybe I'll move on to another house. So we've received the commitment letter. We've met the date on the purchase and sales. On your approval letter, and again, this is very important, on the second page or somewhere on there is typically anything that when the underwriter at the bank who had lending authority that reviewed and approved your file might have a list of conditions to that approval. They might want to see that your deposit checks have cleared your account, so when you get to the closing table, they can credit you that money towards your down payment. Depending on how long it is from application to close, they may ask you for updated pay stubs to show you're still with your employer. Updated bank statements, again, usually they want stuff to be within about 30 days of the closing. If there's anything specific to the transaction, maybe for the property, again, maybe something came up with the appraisal, maybe they said, oh yeah, there were termites, but we treated it. They may say, okay, we want to see proof that the termites were treated and proof of payment that the seller paid it, things like that. Those things, in light of that whole closing document, again, being given to you within the timeframes, you want to make sure those items on the commitment letter are sent in as soon as possible, because your file needs to get to the closing department as quick as possible to make sure that we're meeting those deadlines. And I always say, your file is your home, your application, and then we have everybody else's in there with you. And to me, the less stress we can put on anybody, the better the whole process is. When we're rushing things, that's when mistakes get made and things like that. So if we can clear everything up, get you to the most of my stuff I'm clearing about 3 weeks to a month before the closing date right now. I got a call from a broker today. He's like, the commitment date's today. I said, yeah. I said, we already have them cleared to close. He goes, oh gosh. He goes, I forgot you said that was all set. So if you can be proactive, and again, it's all communication. It's working with your lender, working with your real estate agent, and just making sure that, you're looking at the stuff that's coming to you and you're getting things in as they're asked. Yes, Chris.
So if you submit an offer to a seller, is there any time frame associated with when they have to either accept or reject the offer?
So when you submit your offer, is there a time frame? Yes. They would typically, you could put, you have this many days to accept it. Or they may just come back to you and say, we're going to think about this for X amount of days. But usually you'd put a time frame in there, whether you want to give them 36 hours, 72 hours, whatever, if you're anxious, if there's other, that you can definitely put a time frame in there. And then if they don't, they might ask for an extension. But, your time is valuable too. You want to, if you're putting an offer and you're serious, you don't want to leave that window open for all these other offers to come in. So you would decide, you and your real estate agent would decide what to put in there as far as your offer. Once you have your approval letter, on there is typically going to be the wording that needs to be on your insurance binder. You're going to be obtaining homeowners insurance. So one of the things we talked about in the beginning, when you're renting, you don't have to insure the place where you're renting, just your contents. Now your home is the bank's collateral for the money that they're lending to you, and we want to make sure that it's protected. So like anything else, you're going to shop around and get quotes for homeowners insurance. You have your automobile insurance with somebody now. If your agent takes really good care of you, that's the first place you want to go. You want to talk to them, and you might be able to get a multi-policy discount with them. And get your homeowner's insurance. Again, it's one of those things where before everybody did that last minute, now you want to get those figures as soon as possible, because that closing document can't be prepared without the insurance. So part of your mortgage payment, you have your mortgage payment on the money that you're borrowing. In addition to that, you're going to be paying your homeowner's insurance, the real estate taxes for the property, and then any private mortgage insurance if it's applicable to your mortgage.
What's a private mortgage insurance?
When you put less than 20% down, a lot of times the lender will have mortgage insurance, which protects the lender. Back like when my parents bought a house, everybody pretty much did a 20-year mortgage and had 20% down. What happened was prices of houses started going up, and it was harder for people to put 20% down. So somebody, I wish it had been me, came up with the idea of creating a mortgage insurance company, and they sold themselves to the bank saying, we'll reduce your exposure so it's as if you had 20%. The sellers are going to pay the premiums, the buyers, are going to pay the premiums. So you're able to still do mortgages and have the same risk that you would with somebody putting 20% down. And the burden of the extra cost is on the buyer. So
is it like a gap insurance for a vehicle?
Kind of, yeah, because if they have to foreclose, there's attorney's fees, the property may have dropped in value, there may be damage to the property, it helps them to incur less of a loss, the private mortgage insurance. It's not necessarily for the life of the mortgage. On VA, I believe VA and FHA mortgages now, it is for the mortgage insurance that you pay on those programs, it is for the life of the mortgage. On conventional mortgages, typically, once you have 20% equity in the property, you can petition the bank and see if they'll drop it. So if you've been making extra payments towards the principal, property value started, you see your neighbor's house just sold for X, and you're like, hey, it looks like I have 20% equity. Might be, a few years down the road. Usually you have to have made at least 12 to 24 payments, and then you can petition the bank if it looks like the equity's gone up. They may have you pay for an appraisal, but if you've been making all your payments on time and the equity's there, they generally drop it. If you do nothing, usually it's about, it depends on property values. I think it's about 15 years, maybe 11 to 15 years. When your loan amount, your loan balance, and the original appraised value, it looks like you're about 22% equity, you'd get a letter saying, hey, you might have 20% equity, you may want to see if we can look into dropping off the mortgage insurance. If you did nothing, they do that.
Includes that in the mortgage payment?
Yep. Now, there's been twists over the last few years. There's the standard monthly premium on regular private mortgage insurance companies. If you were to get a seller credit, you might just be able to pay the mortgage insurance and up front in full. It might be maybe a few $1,000s, but then you wouldn't have the monthly fee. Some of the programs will work it into your interest rate. So maybe instead of having 4.125 and then have a monthly fee on your mortgage insurance, they might give you 4.625, and it's built right in, and the difference might be $50 a month. But then you sit there and you weigh and you say, okay, well, I'm only going to be here 5 years. I probably won't gain 20% equity in 5 years. I'm going to go with this one and save the, whatever it is, $40, $50 a month. Or I'm going to be in this property. I see myself here for a long time, and I think I'm going to be able to make some extra payments here and there. I'm going to go with this option and try to drop the mortgage insurance as quickly as I can and benefit from keeping that lower rate. So again, those are different things that we'll work out when we sit down and we say, okay, what's the game plan? Knowing that, things change. If we all had that crystal ball, we'd make the right decision every time. But, you're going to make the best educated choice based on, where things are today. Once we get all your conditions in from the approval letter, we get your homeowner's insurance, that closing document's prepared, you get that figure before the closing, you'll know the amount of the bank check. They're going to require you to bring a bank check to the closing a few days before the closing, and you get to wait impatiently to sit at the closing table and sign paperwork for almost an hour. Sign your name over and over again. I always say we're paying for the sins of the past. A lot of it's repetitive, but it's all for consumer protection and making sure you understand everything that's going on with the mortgage. You're going to be required to bring identification, which they're going to ask you for up front too. You're going to review your loan document, again, your closing document before signing. Again, it's an hour's worth of signing.
And a lot of that stuff is legal.
It's all fair. It's not like you can say, oh, we're gonna cross out this line over here on the mortgage instrument. I don't like that. It's not negotiable. It is what it is. Yeah. Most of it's federally regulated stuff that just, again, it's more information than anything else. If you're the type of person that likes to read through everything, I suggest letting the attorney know that ahead of time. Say, can you give me a copy of the package so I can review it before I get to the closing table? Again, I've had people do that. It's probably been 10 years since I've had somebody request a package. I don't know necessarily that that's a good thing, but most people just say, I'll get to the closing, the attorney's going to explain it to me, and I'm going to sign it. But you do have the right to read through the whole thing beforehand if you want. Just make sure you let the attorney know. And I know all the attorneys that I work with are going to give you copies right at the closing. Some of them even have it electronic now of everything that you're signing. So you walk away from the table with copies of everything. Any questions? I've been talking a lot. So this is where I was jumping forward before. Paul, when you were talking about pre-approvals and pre-qualifications and without looking at the slides going forward, do you want to try to guess Any idea what the difference is? Is there a difference between a pre-qualification and a pre-approval, do you think, or are they one and the same? I hear people interchange the two all the time, mostly real estate agents. Which one do you think's better, a pre-qualification or a pre-approval?
I think a pre-approval.
I agree.
You are correct. So I have real estate agents call me all this time and say, oh, can you get me a pre-qualification on this customer? A pre-qualification is more our informational visit before you're ready to do the pre-approval. A pre-qualification is looking at what you want to spend, what the guidelines are, what your income is, and me and you and I looking everything over and saying, okay, this looks like where you'd fit within the guidelines. I don't have lending authority. I don't have that magic pen. I call my boss's pen the magic pen. I don't have that pen that can sign the bottom of the page and say you're approved. My job is to help you through the process and guide you through it and educate you and help you make good decisions. But they're the ones who sign the bottom. So if you just sit with, ask them, do you have lending authority? Because plenty of originators are allowed to give out what they call pre-approvals. But in my eyes, they're really pre-qualifications, and they're only worth the piece of paper that they're written on.
Sounds like getting one of those credit card things in the mail.
Yep. Right. And really, it's as good as the knowledge that the person who is writing it out. You know, I like a second set of eyes on everything. You know, some things are very cut and dry, but some aren't. Do I think I could do pre-approvals? I sure think I could. But you want to make sure if somebody's saying, oh yeah, here's a letter, say, you have lending authority, and make sure you know what you're getting, because you don't want to have those surprises. That's one of the things that we do that I really like, is that each file, each time you make a request, is fully underwritten. All your pay stubs are reviewed, your bank statements, and it's not me typing up the letter. It's, you know, the VP of the bank looking it over and saying, yes, we can do this. This is good. So as you know, as long as your financial picture doesn't change, you're not going to be surprised at the end. The only thing we have to review is the appraisal, like I said before. Pre-qualifications, you don't always have a full credit report either. They may just pull what's called like a soft credit. So they might only hit one credit bureau. And then when you go for your live application, they pull all three, TransUnion, Equifax, and Experian. And now you find out, oh, there was this medical collection account that I didn't know about. When we look at your, I'm jumping forward a little bit, but when we look at your credit, we're going to pull all three bureaus, and we're going to use the lower of the three scores that you have in determining your eligibility, whether you qualify or not. So if they happen to pull the best one, you know, that might not, your score may not be within the guidelines when they pull the other two. So again, just one thing that you want to make sure when you're going through the process and you want a pre-approval letter, that it's a true pre-approval and not just a pre-qualification.
Jennifer, as far as the credit reports, so if you shop around for a lender and that lender wants to look at your credit, they're going to pull your credit report and charge you for that. And then if you go to another lender, are they going to pull the same credit report, or?
Yes, we all have to get our own,
So
because
that's
it can't be
going to ding
tampered with.
you
It
on
has
the
to
credit
come.
report each time those come up.
You're going to have
Those
inquiries.
are card inquiries?
Yes. Yep.
And does that affect your credit score?
Yes. What happens is, if you were to pull, what I'm told from the credit reporting agencies, if you were to go to 3 different lenders within a 2-week period and they were all mortgage inquiries, it only shows there was 1 hit. If you were to come to me, and then 3 weeks later you went to somebody else, and then a month and a half later you went to somebody else, now you're going to have 3 mortgage inquiries over an extended period of time. And statistic-wise, they say they might not be shopping anymore. Something might be off on their situation, and they're not getting the terms and conditions that they want, so they keep going to different banks. So if you're going to shop lenders, you really want to do it within a 2-week period to be safe, so that you're you know, not taking any more points off your credit than you need to. Now, on a 2 weeks. 2 weeks. I heard somebody say 30 days, but when I checked into it, it was 2 weeks. So that's the one that I always go off of. If your credit's really good, if you pay your bills on time, you don't max out your credit cards, chances are a few inquiries is not going to damage you enough where it's going to change your terms and conditions. But if you're borderline, you really have to be careful, because you'll go one place and get good terms and conditions, and then all of a sudden Now all of a sudden, terms and conditions aren't so good on the mortgages that you're getting, and you can't go back because we're going to pull a new credit. Again, they're going to pull a credit report the day before you close. And again, if you walk away with this, anything from this, once your credit's been pulled, be careful not to make any changes. Opening new accounts. Don't even close old accounts. If you say, I don't use these accounts anymore, I'm going to close them out. Part of your score is the length of your relationship with your creditors. So you really don't want to be making changes. Christmas time, you don't want to be, out there, I'll take 15% off the gap, take 15, they're going to, give me these deals. Well, all these inquiries are showing up now, and you're extending more credit, and it's new credit. So all those things can impact you. You have time, and I don't know that necessarily that I have it in here. If you want to check your credit, we all see the freecreditreport.com and things like that on the commercials on TV with all the different companies out there that are free. The only one that I know of that is the direct link to the credit bureaus is annualcreditreport.com. It brings you directly to them. There's no middleman, and you can get a free credit report from each one within a calendar year. That's how I pull my credit. You don't get your score, but again, if you're generally paying your bills on time, you're not going to, chances are your score's fine. The best way, like when people bring in their scores all the time that they have from this website or that website, it can be 50 to 80 points off from when I pull it. So for me, I don't find them to be accurate. Some of your credit cards now, those will give you your credit score, and those are almost spot on every time. I have a Discover card, and I know they have my FICO score, and that's right there.
So with credit cards that you don't really use, that they just keep bumping up your available credit, you said it's a negative, right? And I've heard that before, to cancel it, it's an older line of credit. Mm-hmm. But is there any downside to having that open amount of credit if you're not utilizing it?
No, when I first started in the business, we used to put like a $10 or a $20 payment on any credit card that you have that didn't have a balance. So some people who had a lot of cards, all of a sudden you were adding a few $100s onto their payment and they didn't qualify. But they don't do that once they moved over to credit scores. They stopped doing that. If you don't have a payment on a revolving, they're not going to put in a payment for it. They're just going to assume that, okay, if you pay that, you usually pay that one off. So if you think of and I might be jumping ahead a little bit, but if you think of your credit score as a pie chart, the biggest piece of the pie is, do you make your payments on time? But then some of the other things are, do you utilize different types of credit? So do you have a mortgage? Do you have a car loan, student loan, credit card, maybe a line of credit on your checking account? So are you using different kinds, or do you just have a credit card? Do you not use credit cards? Do you just have a student loan? So they want to see that you utilize different types of credit. And then the length of your relationship with your creditors. So are all your accounts there less than 12 months old? Or have you had a card for 5 years and shown a good payment history? People for a little while, and I think more people are educated, there's more out there now about your scores, they'd have a $10,000 balance. And I'd say, oh geez, I got to get rid of this card. I'm going to transfer it to this, I'm paying 15%. Okay, I'm going to transfer it to this one over here and get 0%. And they close that out and they open up a new one. So now this card that they had for 5 years, they lost that long-term relationship. They moved it over here and they said, well, we're only going to give you $10,000, so now it looks like they're maxed out. And they have a new inquiry with a new account, so they're taking points off all over the place. And now, if they had kept that account open, and let's just say that had, 10,000 and this one has 10,000, it would have looked like they had 50% of their available credit being used instead of 100. So if you're using more than 60% of your available credit, that's going to take points off. So that's why we usually tell people don't. Unfortunately, most people came out. Again, if you're making your payments on time, and as a general rule, you use your credit responsibly, that stuff shouldn't hurt you. If you say, well, I've had these 2 cards for a long time, I'm really never going to use this, chances are it's not going to hurt you to close it. But if your score is borderline, you might want to wait till after you get your mortgage to, maybe clean up some of that stuff. So again, the pre-qualification is just crunching numbers. They may say And I believe a lot of the online applications, that's pretty much what you're doing as a pre-qualification too. You're punching in that information. Nobody's reviewing your pay stubs. I see people, put in income that's way different. Sometimes they short themselves because they're using their take-home pay instead of their gross pay. So you have to be careful when you do online applications. If you punch in your information, you get a pre-approval letter with the information you've put in. You're relying on the accuracy of the information that you've inputted. I always say junk in is junk out. So if you do something like that, I would definitely, if they don't ask for it, that lender should be emailing you, calling you, requesting somehow, hey, you want to send in your pay stubs, bank statements, we're going to just double check the stuff that you put in here and make sure everything's accurate and get like a confirmatory pre-approval letter after that. So a pre-approval versus a pre-qualification, it gives you a better idea, but to me it also gives you better peace of mind knowing that the price range that you're going to be working in should work once you find that house. It also, again, allows you that time to repair your credit. So you go into the lender, they do the pre-approval, the credit comes up, and we say, oh, did you realize there's a collection account? There's a $75 collection account. Oh, I went to the emergency room. They told me I didn't have to pay anything. I haven't received any bills from them. I didn't even know about it. Happened to a guy. And long story short, it dropped 100 points. His credit was, he didn't have a lot of credit. He paid mostly cash. And the poor guy went to the emergency room and didn't pay the $75 and got 100 points knocked off his credit score. So if little things like that, then we work at fixing it. And the credit reporting agencies, to me, are finally becoming more consumer friendly. I always used to get angry because, again, people would pull their scores, and an hour before they came in to see me, and then I'd pull their credit, and they'd say, oh, I have all this, and they're all excited, and I pull it, and I'm like, oh, they don't qualify. And I'd say, okay, well, your score's here, and I'd pull up the report, and they'd say, I don't understand. And it was kind of like shooting, well, what do I do? And I'd say, well, I can see this collection account. It looks like you're using, but I wasn't really sure if you do this. Okay, well, where's your score going to go from here, and how long will it take? They just did an upgrade this year. So now when I'm pulling my credit reports now, they have a source, and it says, okay, you're a 687. If you do these things, it'll add 15 points. And now I can send you to that site, and maybe if you pay down this card or pay off this little collection or whatever, we know how many points it's going to bring. They're much more friendly. There's a fee involved, but before we didn't even have that. So it's nice to have that as a feature to offer.
Jennifer, how long are pre-approval letters good for?
Pre-approval letters, our pre-approval letters are good for 90 days because that's how long your credit report is good for. After 90 days, we request you would send me an email saying, I authorize you to pull a new credit report. I'd like a new pre-approval, the same terms and conditions as before, or maybe you're going to call me and say, hey, this changed, or I'm thinking about looking at condos now instead of single-family homes, and we may adjust it. So then I'd say, I authorize you to pull my credit. I'm looking at condos. We're going to assume a condo fee of X amount of dollars, and make sure that you're still, you still qualify for what you're looking for. And now you're off and running for another 90 days. And you want to keep an eye on the expiration date on your pre-approval letter. So again, what always happens is it expires, and the week later they call me and say, oh, I'm looking at a house. The broker said I need a new letter. And I mean, we can do them pretty quickly, but if it happens to be real busy, there might be a stack of pre-approvals on the desk, and I want you to have your letter when you need it. I have them tagged in my system too, but I would say if I'm keeping an eye on it and you're keeping an eye on it, then we don't have any problems. So again, if there's issues with your credit, we have time to fix that if we're doing the pre-approval, before you go out there and start looking. And then like we had discussed before, the seller and the realtor know that you're a viable buyer. Again, we've already looked at all your finances. You're going to know what paperwork we're looking for because, again, we want to get you in, get you approved, the appraisal in, and get you to the closing department as soon as possible. And again, my underwriter's going to be looking at is the same person that did your pre-approval, so we already know all the paperwork that they're going to be requesting. Now, again, I do encourage you to sit down and just do a pre-qualification and number crunching, just you and I, to figure out where you want to be if you have the time. You know, kind of put that, okay, where's your monthly payment going to be? Let's test drive this payment for a little while. But now you're ready to do the pre-approval. The paperwork that you want to be putting aside, and I do encourage people, it's funny, I have people come in with, you know, plastic bags full of paperwork. Some people have them in binders with everything tabbed and highlighted. But you at least want to keep a file and start keeping, because we're going to constantly be asking for updated information. So what we ask for is your last 1 month's pay stubs. And we're looking at your year-to-date income on those. You know, if you work for, you know, more of a mom and pop shop, if your pay stubs don't show a year-to-date figure, you might want to ask them, you know, whoever does the payroll over there, to do up a letter just showing what your year-to-date earnings are. If you have overtime, commission, bonuses, you know, we're going to be averaging that income over the last couple years, and we want to make sure we're using the best figures. If you're self-employed and not a first-time home buyer, we're generally going to ask you for your last 2 years' tax returns. And again, we're looking for a continuancy of income. For first-time home buyers, they're actually going to ask you for 3 years' tax returns. The definition of a first-time home buyer is somebody who has not owned their primary residence in the last 3 years. So I've done first-time home buyer mortgages for people in their 60s because they were here, they sold their house, retired, moved down to Florida, South Carolina. Then they had a couple grandkids up north and said, I don't like not being near the grandkids. You know, they rented, maybe had a mobile home in a park that they rented for a little while, but didn't own a home for 3 years and moved back. And they're first-time home buyers again. So those benefits become available to them.
So that is, you have not owned
Your primary residence in the last 3 years. So you may have bought a condo. Something happened, you ended up moving back home. And you've shown on your tax returns that that's been your address for the last 3 years, and you've got rental income on the other property. You're a first-time home buyer. Some lenders will say, you're a first-time home buyer, but you can't own other real estate. So if you still hold on to that rental property, they may not allow you to use maybe a special program that they have. So, you know, if that's something that fits for you, you want to make sure. If you have veterans that you're working with, again, they may qualify as first-time home buyers again. Or if they bought a home and then they've been deployed and it hasn't been their primary residence, they could come back and be first-time home buyers again.
And is that the case for this VA home loan also, or is that a one-time deal? I don't know that the VA specifically has a first-time home buyer. I personally don't do just straight veterans loans, VA loans, with the Veterans Administration. I have programs through, mostly that I work with Mass Housing, that have benefits for veterans. The VA loans, and again, you know, when we're talking about programs, and this is a little bit further on, the VA loans kind of came into play because, you know, people who were deployed, you know, maybe came back and didn't really have a 2-year work history back here. Or their credit may have suffered, maybe they were moving from place to place or base to base, and, you know, a utility bill went into collection, and, you know, their credit was banged up a little bit, and then their employment was a little bit sketchy. And they had a hard time getting conventional financing based on the guidelines. So that's where the VA kind of picked up that gap for the veterans. But they were higher risk loans because of the credit, because of the lack of employment history. So the VA loans, the insurance on the VA loans, they don't have private mortgage insurance. They self-insure. So instead of PMI, private mortgage insurance, they have MIPs, mortgage insurance premiums. Same letters, but they're kind of reversed. But generally it's the same thing. It's insurance for them in case the loan kind of goes belly up. The premiums have got very expensive, especially with the downturn that we came out of, because there were a lot of foreclosures, a lot of claims. I believe now, in addition to a monthly fee, there's an upfront fee that you pay. And it's
about 2.25 points, I believe. A point is 1% of what you're borrowing, which kind of answers your question from before, but they can be used in different ways. So a point is 1% of what you're borrowing. So if you have a $200,000 mortgage, each point's $2,000 added to your closing costs, or in this case, it's the premium, it's 2.25. That extra money that you're paying, that $4,000 plus, is going to be added onto your loan amount. And now you're going to pay interest on it as well. And then there's also a monthly fee. So the insurance premiums, the VA loans can be more costly than conventional mortgages. So if a veteran has stable income, employment, and very good credit, the VA might not be the best option for them. That's why I always say, talk to a lender who does VA, get the terms and conditions that they're offering you, and let's put them side by side to see which one is the best deal.
And
I thought that.
Go ahead.
I thought that letter that we print out, that just exempts you from having to put a down payment.
They do 100% financing, yeah, because a lot of times they don't have, but there's other 100% financing programs out there that you might be able to utilize that doesn't have that insurance. So again, it's just looking at the programs and making sure. For some people, the VA might be the better option, you know, but you don't want to disqualify yourself from a conventional mortgage if it's going to be, you know, more affordable for you.
And so conventional, shop around for a lender, they're all different, they can all offer something different, right?
Mm-hmm.
Same thing with the VA loan, you have to shop around for those because there's a lot of banks out there that offer the VA loans.
Mm-hmm. Correct. Yep.
So it's just 100% financing loan, which is offered different places.
Yep. Sometimes the interest rate might be lower than a conventional rate. So I think, you know, a VA loan on a 30-year fix might be running 3.75 right now, where, say, a mass housing is 4%. But then when you add in the mortgage insurance premiums, it becomes much more costly because their monthly premium is higher than the regular mortgage insurance premiums, plus you have that upfront fee. So
I think the attractiveness of the VA loan sometimes is at 0% down.
Mm-hmm.
You don't have to put anything down, which I think is attractive to some people.
Yep. But there are, if you shop around, like Mass Housing has some 100% financing. There's a special program that they just rolled out that's in the package that you have right in front of you there for the Welcome Home Mortgage, which it was a big press release on Veterans Day, which I have in that package as well. If you Google it, Welcome Home Mass Housing, it's that package right there in the very front above your screen. Yep. So Mass Housing, well, I'm probably going to jump forward, but they're the state-run housing agency, and they've come up with a special program here. Their 100% financing is done basically with a 97% first mortgage, and then they do kind of what they call a soft second. There's a second mortgage placed on the property for the other 3% with no payments and no interest. So all the bells and whistles are pretty much in there, and we'll go over that together a little bit further on. But they don't have an upfront premium, but they do have mortgage insurance. You have two options. I looked at them today. The one with mortgage insurance, the rate's 4%, and then you have the monthly fee, which is about, I have to double check, but I think the factor is like 0.6. You'd multiply that times the loan amount and divide it by 12 to come up with your monthly figure. The really good feature with this is typically if it wasn't on this program, their lender paid mortgage insurance. So instead of having a monthly fee, you have a higher interest rate. The bank basically pays for it. If you're not a veteran, if you're not on this program, the rate is about 4.625. But if you go with the option on the Welcome Home, it's 4.125. So for only an eighth more on your interest rate, you don't have that monthly mortgage insurance. And you still have the protection of the Mass Housing mortgage insurance. It's called MI+, which also includes unemployment protection. So if you got hurt, you're disabled, you got laid off, you involuntarily lost your job, they'd help you out with your mortgage payments for up to 6 months. Now, there's some terms and conditions, but I know customers who have used it. So I think that's huge. Especially if you're buying a mortgage by yourself, it's nice to have that parachute if something were to happen, because like we said before, we kind of don't know what's around the corner sometimes. So that's given a lot of people peace of mind, younger teachers, guys in construction, You know, people who, you know, just, you know, geez, they're talking about layoffs. I might be fine, but, you know, sometimes they've had that hesitancy before, you know, before buying a house, and this kind of gave them the peace of mind to say, okay, I'm gonna, you know, I should be okay. So I was really excited about that when I kind of saw that. And then, you know, I've been working with Mass Housing for 20 years. And what I like is they're not a bank. They're a housing agency. All they do is mortgages. There's no checking accounts, savings accounts, credit cards. It's all about you and your mortgage. So I know when I send somebody over there, they're taken good care of. So if there's a problem, if anything happens, you know, I can call Goretti, who was going to be here tonight. Unfortunately, she wasn't able to make it, and say, you know, I've never had to. In 20 years that I've done a mass housing mortgage, I've never had to call over to their customer service division and say, how come this customer's taxes weren't paid, or how come? And I know if I called them, they'd be like, Jen, let me find out what's going on, and I'd have an answer, you know, within a short period of time. Where if I called a big bank that we sold mortgages to, they'd be like, Jen Banks, Oldfield, who's Bristol County Savings Bank? You know, there's no relationship there. And, you know, I think with the bigger banks, you know, I saw it on the last downturn, you know, people would come in and say, I've been trying to work with my big bank, and, you know, I lost my job and they weren't helping me, and that doesn't happen now. You know, they helped those people, Mass Housing helped those people to stay in their homes. So that, again, just makes me feel better putting mortgages over there and making sure people are successful.
You brought up selling the mortgages. I just had a colleague who got her mortgage sold, and she wasn't even notified. Is that a common thing that happens?
Not being notified is not common. They're supposed to be notified, I think, at least 60 days prior to, because they can't change the terms and conditions of your mortgage. Like we said at the closing, you're signing all those documents, and, you know, the bank, just like you know, you're saying, I'm going to pay this every month. The bank can't all of a sudden say, hey, we're going to jack your rate up to, all that they can change is who the payments go to, and there's certain procedures. So if she didn't receive notice, you know, she wants to get on the horn to somebody. But they
If you have automatic payments going to a certain bank, that might change.
The majority of people are doing payments online, and if it went to the other place, now did it get credited? Are you ever going to get that money back? It's a little nightmarish. So, no, she should have been notified, most definitely. That there's strict, you know, laws and procedures as far as when a loan transfers servicing. And again, that's one of the reasons why I like Mass Housing too, because they don't sell their mortgages. You know, it says right at 1 Beacon Street in Boston. So that's, you know, that's an additional feature. It is common practice for mortgages to be sold. Almost all the lenders will reserve the right to be able to sell your mortgage at some point. Okay.
Jen, for one thing, you said a point was 1%
Of what you're borrowing. Yeah. So $200,000 mortgage, 1 point would be $2,000. And again, depending on what that point's used for, it could be added to closing costs. You know, if it's a mortgage insurance premium, it might be added into your loan amount. And this is a little Jen Banks mortgage. This is just my theory more than anything else. But for a while, their mortgages were a hot commodity because banks had mortgages on their books that were 8%, 7% that they were holding and collecting on. People just didn't listen to the news. They didn't know they could refinance. Their life was busy. They just never gave it a thought. They just, you know, chugging along, making their mortgage payment. So banks could say, oh, hey, I'll buy those performing high-rate mortgages off you for this, and you won't have to service them anymore. And now you can lend. You can, you know, reinvest in your community, whatever you're going to do. So mortgages were more of a commodity. So you'd hear people say, geez, my mortgage got sold 3 times this year. What's going on? Because they could buy those. They said, it's cheaper for me to buy these from another bank than to pay somebody to originate and put it on the books. Eventually, mortgage rates are going up. We keep saying that, but they haven't hit there yet. But I think, you know, they're going to go up. They might go up to, you know, the 6s, 5s, wherever they end up. And all these 3% and 4% mortgages, I don't think they're going to be a commodity. You know, banks will probably hold on to them because there isn't going to be another bank going out there, oh, hey, I'll buy that off you. They're going to say, well, I'll put a 7%, 6% and pay the cost to put it on my books. So.
One more thing, I don't know if you said this already. Is it a buyer's market right now or seller's market?
Honestly, for me, from what I've seen, it's a pretty even playing field. I don't think anybody has an advantage right now. I'll leave it at that. Yeah, I don't see that it's either at this point. We'll see what the spring brings. But it's been getting busy. I've been finding people,
It's a good
the
question.
turnaround time
People
on the
always say,
pre-approvals
is
to
it a
find
good time
house
to
is
buy?
lower.
I think it's going up. And how do you determine that?
Well,
Isn't it interest rates?
everything's, when the economy's doing well, rates go up. Bad news for the economy is good news for mortgage rates. Good news for the economy is bad news for mortgage rates. But good news for the economy means we're making more money, So, you might be making more and be able to qualify more and qualify for that higher payment. So, there's growing pains when, the market changes, but as a general rule, everything's got to be affordable. If rates go up too high, too fast in relation to people's incomes, it's all going to screech to a halt. And the housing market is one of the biggest drivers of the economy in my eyes. People buy a home, then they're hiring painters, they're hiring contractors, they're hiring landscapers. So it's a huge driving force. Back a few years ago when it was slow, they actually had a credit for first-time home buyers when they bought their house, and then when they filed their taxes, they got a chunk of money back. So, there's things that they'll do to keep promoting that if there's a...
What sort of tax advantages would there be? Because I think I can speak for you too. If you're a single guy,
Yeah.
it's really there's nothing really we can claim,
As a general rule, I'm not an accountant by any stretch of the imagination, but I want to say roughly if you have maybe a $250,000 mortgage, you're probably paying somewhere between $6,000 or $7,000 in interest for the year. Don't quote me on that. I'd have to do the math, but my general knowledge, and you get to deduct that. If you're paying mortgage insurance, they just extended that for another year. Your real estate taxes, so it helps. It helps. That's one thing that you'll definitely see a difference. So tax returns, W-2s, first-time home buyers, they'll ask for 3 years tax returns. Again, not so much for income, but to show whether you owned your primary residence in the last 3 years. And then this is 3-month statements, but you're probably looking more like 2 months bank statements. And nowadays, everybody does everything online. The big thing with the bank statements that you provide, you want to make sure the name of the bank's on there, your name's on there. A lot of times when you do the online, it may say, okay, Ripped Marine, and then have, because that's your code name, and then have your stuff, and there's nothing that ties it to you specifically. So those are the things that you just want to look at and make sure the bank can tie it to you. Your last 30 days transactions are there, the name of your bank's there, your account number, so they can tie it. Usually on the online sites, people usually do screenshots. There's usually a link that will get you to the statement that looks like what would have been mailed to you. And that's really what you want to print out and give to your lending institution. And when they get those, they're going to be reviewing it. Again, they're going to be looking at and again, statements for credit cards and installment loans. Not so much nowadays unless you've had changes. The credit reports are pretty current. If you know you recently paid something off, you could provide a statement, and if we could see it was more recent than what was being reported on the credit report, we could use that. Installment loans, generally your car loan's going to be reflected on your credit report, so unless you've just bought a car, you may want to show that the other one was paid off and what the payment is on the new one to make sure that we're, again, using good figures when we're qualifying you. The big thing is student loans. If you have student loans, especially if they're in deferment, causes a lot of difficulties in qualifying you for a mortgage. If there's no payment listed on the credit report, we typically take 2% of what the balance is and use it as a monthly payment. It's crazy higher than what the real payments usually are. So a lot of times if they're in deferment, you can go to the student loan website and do a calculation. If I was paying this, what would the payments be now? And we'll use that figure instead. Just a big thing. That's probably one of the biggest problems that I run into with first-time home buyers is student loans. I think you can imagine why this information is needed. Again, we want to back up what we've put on the application. And they're looking for the stability of your income, the history, the continuance of it, the income that you're receiving and we're reporting. Is it likely that's going to continue? Again, overtime bonuses, self-employment, they're doing an average of the last 2 years. Year-to-date figures are important, again, because if you're far into the year, you may have been having a really good year and you don't want to, you want to utilize as much of that as possible, or you may not if you don't think it's going to be stable. But if you want to use that income, we might be able to do maybe an 18-month average, especially if, you know, if you were in sales and you're building relationships, if you're good at what you do, chances are that's gonna grow. So we want to give you the benefit of the doubt. If you know it's not something that might, you know, you're on a special project and you're working overtime that might not be there later, you really don't want the lender. You probably don't want to count on that income going forward for 30 years. So those are things that you wanted to take into consideration again, where the bank may say, oh, well, we'll give you X. But you say, I'm not comfortable with that monthly payment. When I'm doing my figures, I'm not taking that overtime in, because what happens if it goes away? Those are decisions that you want to make, even if the bank would count it. Do you have a question?
So if you have a job that you're able to project out, you know, yearly raises and things like that, that's going to be beneficial. When applying to the loan, you should bring that sort of information with you.
Yes, honestly, the only time that they really look at projected raises that I see so much, I mean, unless it's really imminent, is when we're looking to give out gifts and grants. Because if you have one that's coming up, there's usually income limits on some of those programs, especially if they're giving a grant for a down payment, and they have income restrictions. And it's almost like pulling teeth sometime to get that money out. So said, are you trying not to give this money out? Like they're looking for reasons not to. I don't usually see it, like I said, unless you know like within a month you're going to get a raise, and they're usually using what you have right now and what you have a history of receiving. If you've just got a promotion and you went to, you know, district manager when you were just, you know, a store manager, well, that's going to create an increase in income that's going to be stable if you're a base salary. That's when you'd say, hey, I don't have a history of this, but look, here's my letter when I accepted this position for my promotion. Now we can use that, even though there's not a history of it, because it is, you know, stable. Again, it looks like it's going to continue for more than 3 years. I had, you know, it's tough. You know, I'm a commissioned employee, so I can empathize completely. But I had, you know, a young gentleman come in. He was out of college. He studied really hard. He had been working for about 6 months. Right out the gate, making really good money. You can tell he's going to be phenomenal, very successful. I can't wait to see him again in a little bit. Can't use his income, not a dime, because he's full commission. No, sorry, very, very small base, like maybe $20,000 a year, and all the rest was commission. Can't use it. He doesn't have a history of it. So it was very disappointing. It broke my heart to tell that couple, but you know, they're doing things that they can now. And then, you know, she was a hairdresser and had all tips. So it was, you know, they were very successful. It's just on paper, we couldn't necessarily prove it to a point where we could get them a loan just yet. So, you know, we put a plan together for them, and I know they're going to do great, but, you know, those are things that we have to take into consideration. So I've already, you know, we've been talking about loan decisions for quite a bit. So the bank's looking at your ability to pay. Oops, sorry about that. The down payment and closing costs. All these things are, you know, I always say layers of risk. And the fewer layers you have, the more likely that you are going to get approved. The last thing that they look at, a lot of people come in and say, oh, well, you know, I'm putting down, you know, 40%. Doesn't that make a difference? The collateral is the last thing that the bank looks at, because they don't want to end up. Loan to value ratio, so the percentage of the value of the house based on what you're borrowing. So again, if you had a $200,000 mortgage, if you put down 3%, your loan to value would be 97, you'd borrow 194. They're going to look at your credit to determine your willingness to pay. So based on your credit history, they're going to look to see, you know, what's the likelihood that we're going to get our payment every month. The credit score, we kind of talked about this earlier. We have, you know, the payment history, the amounts that's owed, the length of your credit history, and your relationships. The types of credit, if you're utilizing different types of credit, and have, you know, any new credit that you've opened. So again, you know, just keep an eye on it. The big thing is, you know, making your payments on time. Again, I encourage you to go to annualcreditreport.com. So again, if you're looking for this later, it is in the slides, to get your credit report. I use it 3 times a year, so I'll go in the beginning of the year and pull it from TransUnion, the middle of the year from Equifax, and the end of the year Experian. So I can check it 3 times and make sure everything's being reported. If you know you have issues, you really want to pull all 3, because again, something may show up on one that's not on another one. As a general rule, most creditors report to all of them now, but before there used to be some disparity. They didn't always report to all 3.
Jennifer, the website you had there on myfico.com, what was that for?
MyFICO?
MyFICO, yeah.
You can actually get that if you go to the myannualcreditreport.com. I think the MyFICO's on there. You'd have to pay to get your score, but that's pretty much what, if you paid to get it, that's probably what I'm going to get when minus maybe a few points when I pull the credit report. So again, when you're making your mortgage payment, it's going to be more than just the money that you're paying back to the bank. We're also going to collect the taxes, the real estate taxes, the homeowner's insurance, private mortgage insurance, and the association fee if it's a condo, or there's an association maybe for landscaping or upkeep for the neighborhood in certain communities. So your principal and interest payment, that's not going to change, but the portion of your payment that goes towards principal and interest does over time. Initially, almost nothing's going towards your principal, so that's why anything extra that you can pay is important. But especially if you're doing the online banking, when your real estate taxes and your homeowner's insurance premiums change, that payment's going to change. So you always want to pay attention to those bills. I have a lot of people refinancing. I say, what are your real estate taxes? I have no idea. The bank pays it. Well, you really want to stay on top of those things so that when you get that bill, you know you may get notification from your bank that your payment's going to change. And there could even be a shortage in that escrow if the taxes or insurance have gone up significantly. And they're going to ask you, you need to pay. We paid it for you, but now you got to pay us back this $200 that was short when we paid out of your escrow account. And an escrow account is an account in your name that the bank is holding, that we're putting those monies aside, and then when those bills come due, it'll get taken from those accounts and paid directly. And you'll always check your due date on the bill. Taxes are due February 1st. When you get your statement for your February 1st payment, you'd see escrow from distribution, and you know that your taxes have been paid. If it's not there, then you want to make a phone call and say, I had on my calendar that my taxes were due. I didn't see anything come out of my statement. Is everything okay? Do you need a copy of the bill? 99 times out of 100, it should all be automatic, but you're the homeowner, and even though the bank's making you escrow, which they typically do if you have less than 30% equity, you want to make sure that it's being done correctly because you're the one who's going to get the notice when it doesn't, and if you don't want your insurance to get canceled either. So when, going back to when you're comparing loan products, you're going, interest rate is interest rate, but like I was saying before, I was comparing those 2 different programs where you had one that had a lower interest rate and a lower principal and interest payment, but a higher mortgage insurance premium versus the other one where it was built in. Those are the little things where you say, well, why would I go with this program? The rate's higher. Your monthly payment might be lower when you look at the overall payment on something like that. And that's when you say, well, geez, I might not be there long term. This is a better option for me, even though the rate's higher, because your savings over that period of time might be better, even though the interest rate's higher. So just, again, it's being educated, asking questions, and making sure that you're comparing programs. Up front, you're going to want to know any fees that need to be collected. Like I said before, generally on a pre-approval, most lenders aren't collecting fees on pre-approvals. We're absorbing the cost of the credit report and the underwriting fees, things like that. But when you go to apply and we go to order the appraisal, that's a big expense. So the bank's going to have you pay that out of pocket. You may have rate lock fees, things like that. That's when your checkbook comes out. After you make that initial deposit on your offer and your offer gets accepted, keep the checkbook out, because then you have the home inspector fee that you're going to write. And if you're taking a home buyer education course, which you might even take beforehand, it's not a bad idea, you might have a fee for your home buyer education. So those are all things that's when you'll start wanting to be prepared to write those checks. Again, points, like you were saying, points, back in the old days, points were usually paid if you had extra money and you were going to be in the property for a longer period of time because it bought down your rate. So maybe you'd have 4%, but if you paid 2 points, you might have 3.25 or 3.5. And then you'd say, okay, well, it's going to cost me 2 points. I'm going to break even about 5 years, so I'm going to do it. But what's happened is a lot of people don't keep their mortgage for, longer than 5 to 7 years. So once that's paid, you don't get it back. So a lot of people, and rates have been low, so people have opted to not pay points unless, it was required on a certain program. If you don't want to pay the cash at closing, it basically gets added in. Sometimes nowadays, certain lenders will have what's called loan level pricing adjustments. So on mortgages that we sell, for instance, to a bigger bank, their rates are really good. But what happens is we look at these charts and we say, okay, their credit score's a 700. They're putting down 10%. Oh, to get this rate, they'd have to pay this many points, maybe a portion of a point or 1.5 points, whatever it is, and we have charts we have to follow. And then we say, okay, well, you can pay those points to get the 3.75, otherwise it's going to be 4.125, and we have to do that. So that's, again, just comparing apples to apples, which brings you to annual percentage rate. So on the new loan estimate, you will see your annual percentage rate. Your interest rate is your note rate. That's what your payments are based on. The annual percentage rate is a shopping tool, and basically what it does is it takes into consideration the fees that you're paying up front, like your points, some of the general tax service fees, things like that the banks require to put your loan in place, and it recalculates the rate based on those costs. So if your interest rate is 4% and your annual percentage rate is 4.25, you may have fewer fees than if the bank down the street, you go to them and they say, oh, our interest rate is 4%, our annual percentage rate is 4.75. There's additional fees that you're paying with that bank that are somewhere, up in your upfront cost. It's almost like unit pricing when you're food shopping and you're looking and you're going, well, that's that. And then you look and say, oh, that's $4 per gallon, but if I buy more, it goes down to, $3 per gallon. It's just a comparison tool to figure out which one's the better deal.
You recommend using any of those online mortgage calculators to help us get an idea, or is it going to be too far off?
Honestly, Zillow has a good mortgage calculator now. I believe it's on iPhone and Android. I tried a bunch of different ones to find one that I thought was simple to use. I use Carl's, K-A-R-L-S, mortgage calculator. I just find it, you put in the purchase price, you put in your down payment, your loan amount, the interest rate, how many years, there's your payment.
What was that?
K-A-R-L-S, like might be apostrophe S, mortgage calculator. There's a bunch out there, but I personally use that one. I find it the easiest one to use. And then if you want to get more technical, you can go to the next, there's tabs, and then you can see how much of your payment goes towards principal and interest. It actually will do the whole annual amortization, the whole amortization schedule. So you can see, and then again, if you want to get fancy, if I throw an extra $100 a month, what will that do? So yeah, they're all pretty automated. I don't think there's probably a bad one. It's just which one's easier to use versus another one, and I find that to be the simplest. When you're shopping for mortgages, you want to ask about prepayment penalties. There used to be a lot on adjustable rate mortgages because the bank was lowering the rate initially and they wanted to make sure they made a certain amount of money. But you don't see them as much. Usually you see them on adjustable rate mortgages, but always a good idea to ask, if I pay off this loan early, do I incur a penalty? Just so that you know. And with the new disclosures that came out, that loan estimate up front in the closing document, it's much more clear. It says, will this change? Is this a balloon? Is this, is there a prepayment penalty? A balloon is just, if it was fixed for 5 years and it ballooned after 5 years, it meant that even though they amortized your payments over 30 years, after that initial 5-year period, your balance is due and payable. You either have to refinance or sell the property. So you don't see those as much anymore. Down payment requirements, so when you're comparing programs, again, is your down payment going to change the interest rate that you're looking at? And then, is there something in your situation that one program would work better for you versus another based on your eligibility requirements? Always ask for a closing cost estimate, how long the processing times are going to be, And customer service to me is key. You know, are they going to take care of you now and after the fact? And make sure, you know, if you're talking to somebody and they don't know what TRID is, you want to run in the other direction. Fixed rate versus adjustable rate, you know, mostly common sense. If you're going to stay in the property for a long period of time, you want your payments to be stable. Fixed rate is much more conservative. Again, if you knew or felt very confident that you weren't going to be in a property for a long period of time, I would say compare a fixed rate to an adjustable, see what your savings is over that fixed rate time and if it makes sense to you. But you know, some people made out over the last few years with adjustable rate mortgages because the rates went down, but that's not a guarantee. And where rates have been low for as long as they have, I'd want you to be very confident that you are going to be selling that property within the fixed time frame, because most likely they're going to be going up.
Now, the adjustable rate, is that adjusted every year or every 5 years?
Depends on the program. So there's 1-year adjustables, 3-1, which means it's fixed for the first 3 years and adjusts every year after. We happen to have a 5-5, which is fixed for 5 years and then adjusts every 5 years after. So there's different, you just have to ask the terms and conditions. And then you want to ask the terms and conditions on the ARM. There used to be some crazy ones where after the initial fixed period, the index that it was tied to would change crazily. So you want to find out how volatile that index is that it's tied to, and then there's usually a margin. So when you come up for adjustment, it'll say, okay, the index today happens to be 3, and I have a margin of 2.75. So the bank would say, okay, that's 5.75, but then there's usually caps. So they say, well, you can't go up or down more than 2% per adjustment. So if you started out at 3.125, it couldn't go higher than 5.125, even though that index and the margin was higher. But it can go up every year after. And there's usually a lifetime cap, which is on average 5 to 6 points above the initial rate.
What are the trends on a fixed interest rate, like say over the past 15 years? Like has it steadily increased or?
It's gone up and down. I started in the mortgage business when the rates were coming below 10%, and they steadily went down. I want to say probably till about 2003. It's kind of ups and downs in the middle there, but mostly it's gone like this. And now, you know, we're at historic lows. You know, we're at, 3%, 4% on fixed rate mortgages. When I first started, fixed rate mortgages were about 14, 15%, and your adjustables were 11. So you can see, everything's relative. When I got my first home, it was 7.25. I said, rates could never go below 7.25. Paid a point, said I'm here forever, and they steadily went down. So you just never know. The process, we kind of already went over this, and you'll have that there to review. This is a 7-1 ARM, the Affordable Housing Program. This is Bristol County Savings Bank specific. We do have a really fantastic first-time home buyer program. We'll do actually 10% down with no mortgage insurance. But the key is different lenders may have different, what we call portfolio products that we hold in-house. We're not selling them. And we might have special features that are more attractive than conventional lenders would have, or conventional programs would have. Mass Housing, I told you, was the state-run housing agency. Check out their website, Google Mass Housing. They're, a great institution for mortgages. They're not a lender, though. So you can't go to Mass Housing and get a mortgage. You have to go to one of their participating lenders. And we've been one of their top lenders for most of the time that I've been at the bank that I know of. They, like we said, they service their mortgages. And they cater more towards, because their insurance premiums are lower than the industry, because even though they have low down payments, they only take the higher credit scores. So that's the reason why they're successful. That's why their premiums are cheaper, because they're working with low to moderate income, but they're looking at the higher credit scores. There are grant opportunities out there if you fit within the guidelines for different communities. They change constantly. The new guidelines are just coming out. I'm not sure they put the most accurate figures in there, but they're ballpark. But you always want to check on that with any lenders and say, do you have access to any grants and would I qualify? This is probably just more technical than what you'd want to get into. But basically the grant ends up as a second mortgage on the property with no payments, no interest, and it's forgiven after 5 years. This year, if the Federal Home Loan Bank's going to be issuing grants of $15,000 that we can use towards down payment and closing costs. You have a better chance of getting the grant if you fall within the income caps than hitting it ever on a scratch ticket. So I usually do about 3 a year. And it can work in conjunction with other programs too. Like I said, I work with Pro Home, and they offer assistance as well. You could get a $10,000, I've done them where people got a $10,000 grant from Pro Home, 15 from the Federal Home Loan Bank, and had $25,000, no payments, no interest, and forgiven after 5 years. It's huge. And it's really helped a lot of people get into homes that would have had a hard time getting out of renting, saving up a down payment, and gave them really good terms and conditions because they were able to put a good down payment down.
Is this a grant, this Operation Welcome Home?
It is considered a grant. It's like a soft second, yep. So it's no payments, no interest, and payable when you sell the property.
Are there any other veteran-specific grants?
Not that Mass Housing works with, not that I've found yet. Mass Housing does have one other, benefit that they offer. It's called Home for the Brave. So if you didn't use the Welcome Home, or before Welcome Home was available, they have a little bit more relaxed underwriting guidelines on their regular Mass Housing mortgage, and a $1,500 grant that they give towards closing costs when it's available, and all that's in the package as well. So a grant is usually a gift of money that's given back. Sometimes there's repayment conditions. Some of them, if you sell within a certain time frame, you might owe back a portion of it. But usually, the big thing is if you have a grant on there, you generally, if you've kept the property for a while, you won't be able to refinance and take cash out if the grants are in place. You could refinance, and if you had the equity in the property, pay them off. But they're not going to allow you to take cash out of the property, like consolidate credit card debts, or maybe do renovations to the house. Not to say that you shouldn't ask. I would call the agency, we call Federal Home Loan Bank, or like an agency like Pro Home, and say, hey, this is what we want to do. You're in a second position, but will you allow us to do this? And they call it subordinate. So they're listed as a second mortgage. If you refinance or pay off that first, if you refinance in the case of doing, say, a cash out refinance, they automatically bump to that first position. And the lender doesn't want to be subordinate to another mortgage. So they would have to re-subordinate and stay in that second position. But to do that, they want to make sure that their money's not being put at risk. That, you're refinancing. I had people who were refinancing, the rates dropped significantly, and they just wanted to lower their rate and not take cash out, and they had no problem with the grants. Finally, to the Welcome Home operation. Like I said, there's a lot of information that I gave you. There's the press release. Mass Housing is looking to work with, did I not give myself a copy? Work with the veterans, do special things for them. There's a big push to do this. So Goretti was going to be here tonight. Goretti is the local agent for Mass Housing, and she would have done a much better job of presenting it, and I didn't really prepare for it because I thought she was going to be here tonight. But we're talking about the 100% financing. You have, it would be 97% financing on single-family homes. They'll do 95% financing on multifamilies. Now, outside of Mass Housing, on conventional mortgages, generally on a multifamily, you have to put 10 or 20% down. So it's a huge difference as far as the down payment goes. They'll look at letting you use rental income towards qualifying. There are income caps in certain counties. So if we're going to do a Mass Housing mortgage, we want to make sure that your income falls within the guidelines. If you Google Mass Housing income guidelines, it's right on the website. I think I may have in the package, in the back, the purchase rehab guidelines, which are the lowest of the guidelines. So if your income's below that, you're going to qualify for all the Mass Housing products. If your income's higher, You still may qualify for some of the other programs, so don't feel like you can't use mass housing or the welcome home mortgage. If your income's higher, we'll want to double check that. And they only use who's on the mortgage. So if you and a spouse are buying a property and your combined incomes exceed the limit, you could, if one person's income covered the mortgage and their monthly bills, you could just have that person on the mortgage. They don't go by household. They wouldn't say, okay, well, some of the grants will do that. The grants, even if they're not on the mortgage, they're going to want to say who else over the age of 18 is living in this property, and they're going to want proof of their income to see that the household income qualifies. And on the grant programs too, the more people in the household, the higher your income can be to support that. So those are things that we'll all review in our initial meeting when we go over what's out there, what are we doing, where are we at, what stage are we at, and can we count on there being a good chance of getting a $10,000 grant, a $15,000 grant, or the money, not making the money, so we got to put that aside and work on saving up money, or seeing if there's a gift from a relative that we could get to get us in, or doing 100% financing.
Now, do most lenders, I mean, you know about all these different options, but do most lenders know these options and, I guess, benefits available?
They should. They should.
So if they don't mention it, it would be up to us to like, hey, what about this?
Sometimes you do, yes. I mean, I know, through Mass Housing, for instance, Mass Housing has a purchase rehab program where you can take the purchase price of the house plus the improvements and finance 97% of that. Not all lenders that work with Mass Housing have that program, but a lot of them that do don't even use it. I don't know if they think it's too complicated. It's really simple. It's a little bit more to explain, but it's huge. Like if you watch like HGTV and they say, oh, here's the house, here's the laptop, and they're tearing down walls and they're changing, you can use this program to do it. It's ideal. If you have a house, I did a few of them, failed septic, pipes had been stolen from the house, nobody wanted to touch them. And I had first-time home buyers that could come in and finance, put 3% down, and almost all of them walked out with equity under their belt after doing the renovations and the repairs. So I wish I was a first-time home buyer just so I could use the purchase rehab program. I think it's ideal.
What about pros and cons for rent to own?
It depends on the person. If you're the type of person who something goes wrong, you need to call the guy. I should say, or the lady, right? Yeah. I shouldn't be like that. The person. The person. If you don't have the pocketbook to pay for the person who's always going to have to be fixing things, and you're not that handy, it might not be the best option for you. If your income's not stable, if you're, you don't want to get into a mortgage and not be able to pay it. It's one of, right now you can't even have, if you have one mortgage payment in the last 12 to 24 months, you might not be able to refinance. One mortgage late, it hits your credit so hard now. And when things like that happen, not even just your mortgage is affected, your car insurance can go up. It's all over the place. So you really want to be careful, because it can wreck your credit really hard, and it's really hard to get it back afterwards. Again, it's a matter of having the ability to not only just make the monthly payments, but handle the maintenance of the property, the repairs, the stuff that's going to go, because you're not going to have that landlord. Some people have great families and they have great networks, not even blood family, but just neighbors. And if you're that type of person and you have that really good, strong network, and you have the financial, all for it. But if you're on your own and you're not a handy person and you don't have a big pot and you don't have a good reserve put aside for maintenance, and when things go wrong, now might not be the time to buy. Might be better off renting, doing a short term, finding something affordable, and finding out if you really, I say to my kids every day, you can do anything you want if you're willing to put the work into it that's needed to get you to that place. So if you're not ready now, it's a matter of getting the education, finding out where you want to be and what needs to be done to get you there.
Well, I meant specifically like a house listed rent to own.
Oh, sorry. Rent-to-own options, you hear about them all the time, but it's very hard to do them. You know, what happens is there's a general misconception that, okay, I'm going to move into this house, I'm going to pay rent of $1,000 a month, and then I'm going to get to buy it. Well, what happens is the bank's going to look at it and say, what's the market rent for this house? If the market rent is $1,000, you can't use any of that money towards your down payment. You'd have to be paying $1,500 a month, $1,000 a month for your rent, and $500 to go aside towards your down payment. Most people don't realize that, and they don't structure it properly, and they're not allowed to use it. And what happens is usually it's about a year or 2 years, and they tend to fall apart because the value of the house can change, and somebody feels like they're being shorted. So I've never seen one actually. Maybe in other parts of the country they might work, but I've never seen one work in this area. I've seen people talk about them. I've never seen them actually pulled together. And the couple, it's been years since I've seen one. Somebody came to me, and almost none of them were ever. They didn't talk to the proper people before they drew up the contract, and it just wasn't done properly that it could be used the way they wanted it to be. Does that answer your question? I'm sorry.
I didn't know too much about it. I see a nice house that was rent-to-own, so that's why I asked.
It's real sticky. You got to make sure, you know, you get a really good real estate attorney who knows how to draw up the contract correctly. And to tell you the truth, I haven't even looked at the guidelines in a long time. I'm assuming they're still out there. I've never heard that they changed, but that's the big thing, is you have to make sure in the contract you say, I'm paying this much is towards the rent, which is the going rent. I don't even know if you need to have proof of how you figured out what the going rents were, and then show how much is being put aside towards the down payment to be able to use it. So tricky. Nothing's impossible, I always say, but usually it's not drawn up correctly for people to be able to use it the way they wanted to when I've seen it. VA loans we touched on earlier. Again, there is a benefit to them, to veterans especially if they've had the issues with income, employment stability, or credit. But the big thing to take away is, you know, if you don't have those as issues, you want to get your VA loan information and compare it to conventional mortgages and make sure that the VA is the better option. A lot of people, everybody says, I have my DD214, I want to use it. It must mean I'm going to get a better deal. And in some cases it does, but not always. So just make sure that you compare them to make sure you do have the best product that's going to work for you and your situation. I do have my contact information in there. You know, this may be a long process for you. It could be a year, could be 2 years, depending on what happens. I encourage you to use me as a resource. It's my thank you to you for your service. You don't have to get a mortgage through me.
You're not just stuck in the Taunton area?
No, we and I do mortgages in all of Mass and all of Rhode Island. So construction mortgages, do a lot of construction mortgages. I tend to do a good 80% of my business is first-time home buyers because of the products that we have. But I do jumbo mortgages. I do purchase rehab mortgages. I pretty much do the whole gamut except for government loans. But if you, again, even if you're going out there, if you're working with other lenders, if you want to call me up, email me something, say, hey, I'm not an attorney. But if you want to say, hey, can I get your eyes on this? Is there anything that I'm not thinking that I should? I'd be more than happy to help you. That's my thank you to you for your service.
So
Go ahead.
when we feel like everything's right and we go to our 3 different lenders and get pre-approved, how long is that valid for? Say we don't find the right house.
Yep.
How often will we have to get re-approved?
The credit report is good for 90 days. So that's how long your pre-approved. Look at the different lenders could have different rules. But generally the credit report's good for 90 days. Our pre-approvals are good for 90 days. And then after that period, you would, for us, you would email me, say, I authorize BCSB to pull my credit. I want to get an updated pre-approval letter with the same terms and conditions, or if things have changed, we'd go over, I'm going to look at condos now, so I know now there's a condo fee included in my monthly payment, and I may not qualify for as much because it's going to eat away from what's going towards my mortgage. So would I still qualify for the same price if I throw a condo fee in there, or do I need to reduce my purchase price? You know, we'd go over things like that and then issue you a new letter. If nothing changes, just give us proof that your income hasn't changed and maybe some updated bank statements, and we'll pull a new credit and get you off and running. Again, we do full underwriting, so I usually say between 48 and 72 hours to get a new letter once we get your supporting documentation. But again, you can go online, especially if you have good credit, a good down, you can get a pre-approval letter right online almost instantly. It's nice now. Before, people would come in for a pre-approval, and it's about an hour, maybe an hour and a half of name, address, social security number, your employers. Okay, you had 5 employers over the last 2 years. What's their address? What's the dates that you work? And people going, well, I was there from here to here. No. And it can be a long process, and I'm picking all this information out of your head, and now you're mentally exhausted. And now I'm going to start talking mortgages. So what's nice about what I use the online application for is more a fact-finding tool. So you're home, you put in name, address, social security number, my employers, my banks, credit reports pulled. So now before you come in, I go, oh, cool, let me look at this. Well, he chose this product online, but he might not have known that I have this product because it's not offered online, or he just looked and saw all the programs and said, this has the best interest rate. And then I have you come in and I'll say, there's nothing wrong with this one, maybe necessarily, but I think this or this might be a better choice. This is why, and we'd go over that. And either we'd stick with that one, or maybe we'd move you into a different program at that point that suited you better. And again, that might change as you're out there looking at houses. It might change when you go do your new pre-approval. You could receive an inheritance. You could get a promotion at work. So things can change, and we'll just change your pre-approval as your situation changes. So I've worked with people for up to 5 years, and going back to the credit scores and impacting your score the more you pull, I don't find that, as long as you're not doing crazy things with your credit all over the place, if you're just doing a pre-approval, I've mostly seen people's credit scores improve, I think because they've come in and they've realized, okay, I got to do these things, or they might be paying down some balances, so their score's improving. And I don't find that renewing their pre-approval hurts them. It's usually something, if their credit score goes down, it's usually because of something else.